We wanted to share an update on a busy couple of weeks. The FOMC met to discuss the economy and interest rates. The Department of Labor released their monthly report on the job market. The midterm elections were held, and we just got an update on inflation with the monthly CPI report. As expected, the Fed raised interest rates by 75 basis points, and there are more rate increases coming. The real story of the meeting, though, came during Chairman Powell's press conference, when he indicated the ultimate Fed funds target might be a bit higher than they were thinking only a couple of months ago. He stated rates also might stay at these higher levels for longer than the market currently expects. This led to interest rates going higher across the yield curve, with the one-year T-bill now the peak of rates in the yield curve. After the Fed's move, banks and credit card companies announced higher rates, with the national prime lending rate now at 7.75%. Powell also stated the window to achieve lower inflation without a recession may be closing. His views on rates were confirmed as the Department of Labor employment report showed job growth of 261,000 and upward revisions to the last 2 months' reports. When combined with a separate report showing job openings moving higher and measures of layoffs remaining low, we see a job market that remains robust. Within the Department of Labor numbers, the headline unemployment number did increase from 3.5 to 3.7%, but wages remain at levels well above the Fed's inflation target of 2%. And cooling the labor market remains a key objective for the Fed going forward. The midterm elections have historically been a turning point for the stock market, with positive 12-month performance following every midterm election since 1946. The outcome of this year's election was a bit different than some had expected, but it appears we will have a split government for the next 2 years. Historically, the stock market has had periods of higher returns when neither party controls all three branches of Washington. And the stock market's initial reaction to the election was negative as prices fell. And lastly, we just got the most recent report on the Consumer Price Index, which showed inflation at the headline level of 7.7%, while the more important core rate of inflation was reported at 6.3%. Headline inflation is coming down year over year, and we expect that trend to continue. But inflation remains well above the Fed's 2% target. Still, these numbers were a bit lower than our expectations, and we've seen the stock market rally strongly, more than reversing the post-election declines, and interest rates have fallen across the Treasury yield curve. The Fed should be able to slow the pace of their rate increases, maybe beginning at their next meeting in December, where a 50 basis point increase is possible. But it would seem we need to prepare for rates to stay higher for a bit longer. As a saver, this is not bad news, as we can now find returns on fixed income investments far above the rates that have been available for the last few years. In fact, there are some areas of the bond market where yields look very attractive. If you have questions, let's talk. In the meantime, we thank you for your continued trust and confidence in BOK Financial.